Hello, everyone. I guess we can start. This is the PA UNDP UNEP webinar on green private finance. Before we start, I'd like to give the word to Anne Jupner for some quick remarks at the beginning.
Thank you very much, Gianni. Good morning, good afternoon, good evening, everyone. I'm really pleased to see many colleagues online. Welcome to our webinar today. And I have the pleasure to give some short opening remarks on behalf of Kirsten Stendal and myself. We are the co-managers of the Poverty Environment Action for the SDGs project. With less than 10 years to go before the SDGs 2030 deadline, countries have yet to fulfill their Addis Ababa Action Agenda financing commitments, while many lack the scale of resources necessary to achieve the goals. Filling this financing gap will require a broad range of interventions focused not only on increased public, but also crucial increased private investments. The COVID-19 pandemic has further exacerbated these SDG financing gaps, with financing needs increasing in parallel to significant reductions in the availability of public and private financing for SDG investments. Mobilizing private sector resources in addition to public resources is therefore vital to narrow down the financing gap. A core goal of the Poverty Environment Action for SDGs, or the PEAR project, since its inception, has been to mobilize and align public and private finance for the SDGs. However, although PEAR has been successful in developing and applying a number of tools and processes related to public finance, we have been less successful on the private finance side. To attempt to go a small way in addressing this, we are pleased to convene today's webinar on green private finance. The aim today is to promote private green finance in the Poverty Environment Action for SDGs programming in the UN system and among development partners by trying to better define what we mean by green private finance and to present some of the relevant tools available from UNDP and UNEP. We would encourage our PEAR country-level staff to consider discussing these tools with government counterparts with a view to including these or related green private finance work in the 2022 PEAR annual work plans. Today's meeting will be facilitated by Mr. Gianni Lorenzato, an expert with long-standing sustainable finance experience, who has also advised UNDP headquarters on this issue. He has also supported PEAR in preparing the policy brief on private green finance, which he will present here today. So without further ado, and to make sure we leave the maximum time for discussion, please allow me to hand over to Gianni. Gianni, over to you, please.
Thank you very much, Anne, for the introduction. Just to reiterate very quickly the objective and audience for this webinar, we recognizing the importance of mobilizing green private finance, initially thought of addressing this webinar to UNDP and PA and UNEP country offices, but then we realized that the topic might be of interest also to the development partners and agencies with which the UN works. And as a result, we decided to extend and open the webinar to outside audience. UNEP and UNDP have been working on the topic for some time. UNEP has a full-fledged finance initiative that has done work on topics of green private finance for more than 2 decades, for instance, in the area of promoting sustainable banking. UNDP has increased its work in mobilizing private finance in a range of capacities. It is a large mobilizer of concessional capital from vertical funds such as the GCF, some of which capital is then directed towards facilitating private projects. It has a unit called the UN Capital Development Fund that does work specifically in the private sector, and a range of other services that I will describe a bit later on. We also want to promote the work done by PEA in this context. And on the topic, we'll hear a few remarks in a few moments from David Smith from the team. We only have 1 hour and a half to cover a lot of materials. So we need to stick to a fairly strict agenda. The agenda is as follows. After remarks from David Smith from PEA, I will give a presentation outlining what we mean by green private finance and giving a very brief high-level overview of the tools offered by UNDP, UNEP, and PEA. Yuki Yasui will then go into a deep dive into the work of the UNEP finance initiatives. And at the end, we'll open the floor to questions. In the interest of time and to be efficient, we kindly ask you to submit questions via the chat function of Zoom. Please indicate in the question who you are so that we know exactly your capacity. And also at the end of the presentation, we will share the slides and that will allow you to go through the details in your own time later on. With this, I'll pass the word to David Smith from PEA for a few introductory remarks.
Hello, everyone, and thank you, Gianni. I'm going to make some brief remarks regarding the challenges in addressing private green finance through the Poverty Environment Action Program, and also refer to its precursor, the Poverty Environment Initiative Program. And I'll be making these remarks mainly from an Africa regional perspective to try and set the scene. And for those who aren't familiar, just to highlight the purpose of the Poverty Environment Action Program, we support the integration of poverty environment objectives in national policy and budget allocations, and we seek to catalyze private sector investments in sustainability and resilience that will also contribute to poverty reduction and other development objectives. And the Poverty Environment Action has a strong focus on trying to catalyze both public and private sector finance for pro-poor sustainability investments. And mobilizing private green finance includes creating incentives that encourage the private sector to invest in more sustainable and poverty-reducing activities, creating incentives through regulations, policies, laws, environmental, fiscal reform. And we included in the early stages of our work in Africa a focus on supporting governments to design and implement environmental fiscal reform, mainly on the application of economic instruments, which such as taxes, subsidies, deposit systems, royalties, that would incentivize government to, for the private sector to invest more in sustainability. We, at the request of governments, prepared good analytical reports and recommendations on environmental fiscal reform and introducing economic instruments. These were endorsed in stakeholder workshops, including government officials, but government in almost all cases did not adopt the recommendations. And this was quite disappointing, as you can imagine. And there were combinations of reasons for this. The governments, the political leaders had concerns about the impact on poorer people and whether they had the capacity to design an economic, to design and implement economic instruments. They were seen as complicated. So this good work did not generate change, unfortunately. And in the Africa context, the key poverty environment sector in almost all the countries we work in is the agriculture sector. So we've had a focus on trying to catalyze private sector finance for sustainable agriculture. But the challenges in doing this have been quite significant. One of the challenges is the agriculture sector in Africa is dominated by millions of smallholder farmers, including many woman-headed households. Usually they're very poor and living on the margins without spare cash flow for investments in, say, climate smart agriculture. They are highly risk averse. And in one study, we found that the smallholder farmers had a personal discount rate of over 50%. And that means they would require a very rapid return on investment before they would invest in more sustainable agriculture. And this reflected the fact that they're very poor, you know, and so it's understandable that they're very risk averse. And there are very high levels of subsidies in many countries in the agriculture sector, which do not incentivize sustainable farming and often create disincentives for climate smart agriculture, for example. And these subsidies reflect high level political considerations, and sustainability was not part of the equation. And a lack of strong farmer organizations also hampers influencing financial allocations, investments in the sector. There aren't strong farmer bodies, for example, national farming bodies. And unfortunately, the farm extension services do not focus sufficiently on building capacity of farmers for sustainable agriculture. So they don't have the skills or the motivation, the farmers, to increase the time and financial investment in sustainable agriculture. In the forestry and fisheries sectors, challenges in terms of incentivizing private sector investments include inadequate governance and management systems, including inadequate licensing and royalty systems. For example, in one country, illegal logging was estimated to equal 4% of GDP. So it's very difficult to incentivize sustainable private sector investments when there's such poor governance. We've also found that trade policies can inhibit private sector investment in sustainable agriculture, from very high tariffs to restrictions on exports. And in the energy sector, in the countries we work in, electricity is usually under the control and mandate of parastatals. And these parastatal monopolies plus regulatory hurdles are a major investment in off-grid solar. And that's been an issue and an example for Mozambique, which has recognized it and is introducing regulations to simplify private sector investments in sustainable energy. So we hope that will catalyze a lot of money in, for example, off-grid solar. In summary then, in Africa at least, we faced a number of challenges in trying to catalyse private sector investments in pro-poor sustainability. And we are working to improve our impact, but it's still a challenge. There is one notable exception in this, and that's in Rwanda, where the Poverty Environment Programme catalysed the establishment of a large environment and climate change fund worth over $200 million, which mobilises and allocates funds for sustainability and resilience projects, including a lot to the private sector. And these investments also contribute to social and economic well-being. And a key lesson from this experience in Rwanda is it's so important that the government is willing to put in place an encouraging financial investment climate so that businesses are willing to take the risk and invest. And when you combine strong sustainability objectives like we have in they have in Rwanda, plus a good business environment, this will definitely, it's a winning combination in terms of encouraging private sector investment. Thank you. Over.
Thank you, David. Let me now share my screen and go into my presentation. Okay, I hope this is visible to everyone. Here it is. Okay, so I just wanted to take the opportunity and, first of all, clear some ground and define what we mean by private finance, and then giving a brief high-level overview of the services provided by UNEP, UNDP, and PEA. As Anne mentioned, the goal of mobilizing private finance in the green space is critical to the 2030 agenda. There is a large financial gap to achieve the SDGs, very large, an estimate of $2.5 trillion needed annually in developing countries for sectors such as infrastructure, clean energy, water, sanitation, and agriculture. Mobilizing private capital is therefore key to achieving the 2030 agenda. It is also a parameter that is increasingly valued by donor countries to the development and climate finance community, as well as vertical funds such as the Green Climate Fund. These institutions understandably want to see their grant and concessional dollars used to mobilize additional funds from the private sector. We've also witnessed increasing demand from UN country teams to do work in support of local private finance. And it is one of the key goals of the national integrated financing frameworks. What is green private finance? This slide may perhaps go over a very obvious topic, but just to clarify to everyone that we take the perspective of the recipient of money, it's a use of proceeds perspective. Private finance is needed whenever the investment and the green space is made by companies or individuals, and it is provided by commercial providers in the form of equity or debt or de-risking, meaning insurance solutions. These capital providers, be it commercial banks or private equity funds or insurers, expect to realize commercial rates of return on their investment. As a result, green private finance is not particularly suitable to public good type projects, for instance, financing of essential infrastructure, which is not amenable to charging tariffs and generating revenues. We call it green and not climate finance because it goes beyond the usual sectors in which, at least in developed countries, a lot of private finance has already been mobilized, and those are, for instance, the renewable energy sector. It includes other realms like the preservation of biodiversity and control of pollution. There are many different sources of green private finance. It would be a topic of an entire webinar to go through each of them one by one. Just to give the highlights, we put them in three categories: private capital providers. These are the likes of commercial banks and other specialized lenders on the debt side. On the equity side, private equity funds. On the, again, private credit side, the likes of credit funds, and then other categories of investors which really address specific niches, such as infrastructure funds, venture capital funds, for instance, for fast-growing companies that are trying to implement new technologies to address green needs. So those are the private capital sources. The other bucket is the financial markets. Here, the classic products are listed equities and bonds. So any investor in stocks and any buyers of corporate bonds would be considered a source of green private finance. Such investors include a broad range of entities, including pension funds, other asset managers, sovereign wealth funds, and retail investors. And finally, in the space of insurance and de-risking, this is, of course, the territory of insurers, reinsurers, and credit guarantors. The good news is that on the supply of capital side, there is very much increasing interest towards sustainable investing. Here, the definitions vary, and there isn't really a unified definition of what sustainable finance and green finance mean, but going by prevailing surveys, there is, for instance, an estimate that some 36% of the professionally managed funds in the world invest in sustainable assets, representing a total of some $35 trillion in 2020. We're seeing very much an increase in demand from investors for products such as green and thematic bonds, whose issuance cumulatively reached over $1.5 trillion as of June 2021. New thematic bond categories are gaining popularity: green and sustainable sukuks, blue bonds, transition bonds. There are dedicated green private equity infrastructure and venture capital funds, and ESG and sustainability and metrics are being incorporated in stock exchanges and bond markets. There is, and again, that's a positive trend driving green private finance, increased policy momentum towards mainstreaming of green private finance. A lot of work from different governments and financial regulators, including central banks, on coming up with consistent metrics, mainstreaming green metrics into the work of major financial institutions, improving the management, the measurement of green finance activities and impact, and promoting cross-border collaboration on green investments. So the regulatory and the investor demand trends are definitely favorable to involving more green private finance in the developing countries. Now, and this goes really hand in hand with the remarks made by David. Green private finance is easier to mobilize in developed economies. In developing countries, there are challenges, in particular, the ability to generate out of an investment commercial returns that would be considered attractive by a pure commercial entity such as a bank or a private equity investor. And a classic example is a renewable project where power is sold to a local community. The affordable tariffs in the community in a developing country may not be high enough to allow for full cost recovery, plus the generation of an attractive profit margin for the project developer. In these cases, a solution that is increasingly gaining traction is blended finance, which is essentially introducing concessional capital, grants, concessional loans, guarantees, and other tools in the project financial structure, so that the returns for the commercial investor can be enhanced or project risks can be decreased. The providers of concessional capital are many, multilateral and national development banks, for sure, national development agencies, USAID and the likes, governments in some countries, depending on their fiscal capacity, vertical funds such as the Green Climate Fund, Adaptation Fund, the UN Joint SDG Fund, as well as multi-donor trust funds. Just to give a few examples of blended finance projects, I won't go through the details. This is based on a report on blended finance in the least developed countries published by UNCDF, which I co-authored originally and is now being updated every year. So I encourage you to look at that source if you're interested in more blended finance examples. But for instance, concessional capital has been used to incentivize the launch of a private equity fund addressing SMEs in Congo. It has been used to promote solar power development in Mali, water supply infrastructure in Rwanda, microfinance in Myanmar, and agro-processing companies in Tanzania. UNDP, UNEP, and PA have a range of tools to facilitate the mobilization of green private finance from different angles. We categorize the tools or services in four types. The first one is the facilitation of blended finance projects by sourcing concessional capital. The second one is the facilitation of a project pipeline, the preparation of projects in which commercial investors could inject capital either on a purely commercial basis or on a blended basis. The third category is technical assistance and policy development support. Policy development support, of course, aimed at governments and regulators as the primary target. And finally, the application of sustainability principles is promoted by both UNDP and UNEP. As you can see, quite a long range of tools here, and it goes beyond the scope of this seminar to go through them one by one, of course. The slides will be shared with the audience, and you would be able to I'm sorry, you would be able to review the list of services a bit more in detail, but Just to give you a snapshot on UNDP specifically, UNDP has done a lot of work in mobilizing concessional capital from vertical funds such as the GCF, the Green Climate Funds, over 30 projects approved last time I checked a couple of months ago. Not all these projects address the private sector, but some of them make use of concessional capital to mobilize green private finance. The UNCDF unit of UNDP directly supports private companies by providing technical assistance, but also some concessional capital, particularly grants and concessional loans guarantees. It also supports the launch of impact funds. In the area of pipeline facilitation, UNDP does a lot of work in early stage preparation of climate change mitigation projects. For instance, it is now working on solar mini grids in Africa, early stage project preparation with the objective of also catalyzing commercial and blended capital. UNCDF provides bankability training to SMEs with the objective of making them more appealing ultimately down the line to commercial banks and other commercial capital providers. UNDP has produced in the space of pipeline facilitation a series of investor maps, which are basically sector level grants as of now in 16 countries, but the list is increasing, identifying sectors where there is potential for private investment to really make an impact in terms of fulfilling the SDGs. And you'll see in the presentation when you receive it here a link to the investor maps if you're interested. UNDP also runs impact accelerators where together with industry partners, it runs accelerators for companies that have the potential to fulfill the SDGs, including in the green space. And the policy development area, UNDP does work in private sector development, especially in crisis countries. It has a team that works on insurance advisory, a team that works on thematic bonds, including green and other types of bonds, and the biodiversity finance initiative, BioFin, which is an initiative to identify finance solution, including private, to address biodiversity needs. And finally, in the sustainability principle area, UNDP has issued a series of SDG impact standards for the private equity industry, for corporate bond issuance, and for enterprises. I will skip over the UNEP green finance tools since our colleague Yuki Yasui right after me will do a deep dive into the UNEP finance initiative. But just to reiterate that this is an area where UNEP finance initiative has done work for some 20 years with notable initiatives such as the Sustainable Stock Exchanges Initiative, work on blue economy principles, work on green and blue bonds, environmental and social risk assessments, and as you will see in the next slides, a whole series of other very interesting services. So this will be covered in a few minutes by Yuki. Finally, in PEA, whose focus is primarily on green public finance, has also done work in green private finance. We have here a couple of examples. It has done work in the area of the blue economy, supporting countries such as Indonesia and Bangladesh, and the assessment of the potential for private finance in the space of the blue economy, feasibility report done in Bangladesh on the issuance of blue bonds, which was directed to the government, and includes, for instance, an assessment of potential sectors suitable for the issuance of blue bonds. PA has done a lot of work in environmental impact assessments, methodology to identify the environmental, social, and economic impacts of projects, including in the private sector. This work was done, for instance, in Myanmar, capacity building on environmental impact assessment in the private sector. The audience of the project was originally meant to be the government, but unfortunately, due to the coup, the focus shifted to private sector players and civil society organizations. And there is a handbook on integrating planning, budgeting, and investment tools for the SDGs that covers the entire range of PA finance tools, including private finance ones, which is worth browsing through. Some challenges here for UNDP, UNEP, and PA to support green private finance. As you have heard already, the work of PA has been focused primarily on the public sector so far. So private finance is a bit of a new area for PA. One barrier is the lack of own concessional capital by UNDP and UNEP in support of blended green projects, with the exception of the UN Capital Development Fund, which is a very small pool of capital directly aimed at the private sector. UNDP and UNEP do not have their own concessional capital to facilitate private investments. And therefore, their main avenue of supporting blended projects in the green space is going through donor funds and vertical funds and requesting concessional capital from them. Some of the policy support work that UNDP and UNEP do is very much upstream. It's at the level of regulation and the enabling environment. Actual green investments are further down the line, so there is a bit of a timing disconnect between the work of UNDP and the actual moment when a private investor or lender injects or attempts to inject capital into a green project. Staff of UNEP, UNDP comes primarily from a development background. There are staff members that do have expertise in private sector investment and lending, but it has not been so far the core area of focus of UNDP and UNEP. So there is a bit of a need to adapt the capacity of the organizations towards mobilizing green finance. As I said before, the ability of these organizations to support green private finance is very much reliant on donor contributions and also the priorities of donors, which are shifting. And finally, there is a bit of pushback still from some civil society organizations on engaging with private finance, especially in countries that are very poor and where it is perceived that some services should be provided as public goods. And with this, I finish my presentation. As I mentioned earlier, we very much welcome questions. Please put them in the chat box and indicate your name and role so that we know who the question comes from. The slides will be shared. Let me now pass the floor to Yuki Yasui from the UNEP Finance Initiative.
Thank you, Gianni, and good morning, good afternoon, good evening, everyone. So thank you very much to the PA Secretariat for the opportunity to present on UNEP Finance Initiative. I'm based in Bangkok at the UNEP Regional Office of Asia Pacific. And let me just share my screen while I'm talking. And I'm the Asia Pacific Region's Coordination Manager at UNEP FI. So I've been asked to cover UNEP FI, the UN Principles for Responsible Banking, the GFANG, and the SSEI. So I'll just put my timer on because it's going to be a bit of a squeeze to cover all this in about 15 minutes. So just a very quick introduction about UNEP Finance Initiative, which is the convener of two main principles on sustainable finance, the UN Principles for Responsible Banking and the UN Principles for Sustainable Insurance. And I'll also mention about the net zero alliances later on as well. We are a partnership between the United Nations and over 400 financial institutions around the world, mainly banking and mainly in Europe, but it's actually global. And we do also cover a lot of the developing countries as well. As Gianni mentioned, we are one of the oldest sustainable finance initiatives in the world, and probably one of the oldest UN partnerships with the private sector as well. We have been operating nearly 30 years. We'll be celebrating our 30-year birthday next year. And over the 30 years, we've seen a dramatic increase in private sustainable finance activities around the world. And as mentioned earlier, we have launched the two principles, the principles for sustainable insurance and the banking, but also back in 2006, we launched the principles for responsible investment, PRI, which today is outside of the UN system. And I want to focus a little bit on the UN principles for responsible banking, because it's probably the most relevant for the PEA stakeholders here today, as many of the countries that PEA is operating, you will probably see that the finance sector is predominantly the banking sector, and that the capital markets, which is the investment sector, is probably quite small. So the Principles for Responsible Banking was launched with the UN Secretary General Antonio Guterres in 2019. So it's only 2 years old. It's the last principles that we have launched. But today we already have 260 banks that have signed from 69 countries and representing 40% of the banking industry. And we do have, it is not just the large developed country banks, but we do have very small banks from all over the world, including a lot from the developing world as well. And some are very much the banks that you might want to be engaging in the PA countries. Just a very quick overview of what these principles mean. So I think Gianni's presentation was providing a very good picture of what is private financing in sustainability. And the role of UNEP FI is quite a niche one, in the sense that we very much work at the institutional level, trying to help and nudge the banks and financial institutions to take up sustainability in a mainstream manner. So to integrate it into their business model, integrate it into their strategy and their governance. And the principles for responsible banking, the first principles is the heart of the PRB, and it is about alignment. So banks at the very highest level, so the CEO will be signing this to say that they will align their business strategy with the with the goals of society, which is the Sustainable Development Goals and the Paris Climate Agreement and any other national and regional frameworks. So in order to do that, they commit to understanding their positive and negative impact that comes from their financing activities, and to set targets and to report against them. So it is very much a private sector commitment to say that the world is changing and that their business models need to change as well. So this is a slide that I use when I try and speak with banks to say why they need to sign up to the UN PRB. And the world has definitely changed for the private sector as well. They are seeing that the environmental and social risks are very global, systemic, that cannot be managed away by any one institution, and that they need to be part of the solution for the survival of our species, in fact, but also for their industry and for their institution as well. So, and this means that they need to understand what is impact management, because that is a really useful tool to understand their competitiveness as the whole value creation mechanism in the private sector is going to change with the decoupling, the need to decouple CO2 emissions and resource use with growth. And so the banks are now looking at their business models and are prompted to become future makers and be part of this solution. This is a quick example of ING, which is a Dutch bank. It is trying to align its trajectory on decarbonization with IEA scenarios, the International Energy Agency scenario on net zero by 2050 in each of the key sectors that they lend. And power generation is a key sector that they are looking at, but they are also looking at housing and auto sector and so forth. And another, another example is from Japan. This bank has been developing loans that cut across multiple SDG goals with the client. They sit down with the client to understand what are the sustainability development agenda for that client, and try and identify different target areas that they could target. So in one loan, they could be prompting or supporting their client to look at green supply chain, green production, and even gender diversity or gender equality in the boardroom, all in one loan. This beyond, let me just check, I kind of jumped, yeah. Beyond the PRB, we have a larger set of activities at UNEP-FI. And this is just a quick look, but I won't be able to go into all of them. But PRB is very much looking at the big transition for banks and how they are able to, how they are looking at different thematic issues in environmental and social issues. For example, we are helping them to understand how to set targets on financial inclusion and financial health, which might be one of the more relevant areas for PA. So we have a lot of retail banks that are thinking of setting targets to say, how can I help my community and my client in making sure that our customers are saving for the future and saving for the rainy days and so forth. We have other social issues like targets on gender equality. At the same time, we're doing a lot on the risk management side as well. Like human rights is more a defense mechanism for the bank. It is to make sure that they are not violating human rights according to the UN guiding principles on business and human rights. And we have more innovative financing activities on the purple row, which is things like circular economy and pollution financing as well. Very quick introduction on GFANG. GFANG is a group that was convened for the COP, but it will continue after the COP26 and is led by Mark Carney, who used to be the governor of Bank of England. After 4 alliances that make up the Glasgow Financial Alliance for Net Zero, GFANG, 3 of them are convened by UNEP-FI, the Banking Alliance, the Insurance Alliance, and the Asset Owner Alliance. And what they are is that these are very ambitious commitments that banks are making, investors, banks, and insurers are making to say that they will align their portfolio, so it'd be like a lending, investment, and insurance portfolio to be net zero by 2050, and that they will be working together in order to set the methodologies and help each other in terms of peer learning and setting targets and reporting against them. And then I'll just use my remaining time to quickly introduce the SSEI. It is the Sustainable Stock Exchange Initiative. And this is also another initiative that Finance Initiative is involved in. It is a partnership between the United Nations and over 100 stock exchanges around the world. And in a way, it acts in the same style as Finance Initiative. Basically, the UN is the convener of bringing together the stock exchanges around the world and supporting them in their journey. So it's an institutional change again, for them to be able to support their listed companies to take up sustainability. So over the years, they have been issuing guidance documents around, for example, green financing, how the stock exchange can support green financing, or gender equality, or how to support the listed companies to inform their investors on ESG information, and how the security regulators can support them. The campaign that has been running the longest under the SSEI is a campaign to get all the stock exchanges around the world to provide guidance to its listed companies on sustainability reporting. And at the moment, 53% of the stock exchanges that is tracked by SSEI are, I've got 2 minutes then, are currently providing some sort of guidance. Some of these stock exchanges have moved further and are now demanding mandatory reporting on ESG for their listed companies. I haven't covered so much here, but a lot of the information that the investors or banks are looking for is detailed information about climate data, especially, but other data. And the problem right now is that a lot of the information are not comparable. So there is other initiatives outside of the UN that is currently trying to standardize what companies are reporting on their climate risk and other sustainability information. So I finish my presentation here and stop sharing. Thank you.
Thank you very much, Yuki. Let's open the floor to questions. We haven't received questions in the chat yet, but if anyone wishes to raise their hand and ask questions or make any other remarks, please feel free to raise your hand. We understand that the range of topics covered is very broad. And as I said, you receive the presentations, you'll be able to dig into the materials in depth and reach out to the authors or any of the team members later on if you wish. Okay, I think it looks like we don't have any comments at this stage. I personally found the presentation by Yuki very interested. Perhaps in the spirit of having a bit of a conversation, Yuki, I was wondering what you see as the main challenge in your work at the UNEP Finance Initiative in terms of promoting the standardization of principles, which is a big issue. I know it's been addressed and considered by many institutions. There's a proliferation of principles that are not always consistent among different jurisdictions.
Yeah. So yeah, definitely, there is a lot of different principles, standards, both from the regulators' side as well as the private sector side as well. And I think one of the ones that you will all hear about is the lack of data, lack of information from companies, because they are all apples and pears and very difficult to compare. And that goes, I think, across all different stakeholders as well. And one of the things that Gianni, you picked up about the lack of definition of green financing is also another big sticking point, where the EU has some sort of definition around green financing in the form of EU taxonomy, and other countries around the world are now starting to come up with their taxonomy. And then the biggest example being China. And it's good to see that China and EU have made an agreement on comparing their definitions, and have agreed on some of the key areas of agreement. So those things will definitely help to push for a more consistent understanding of green finance. But actually, what is now starting to become really important is not just green financing, but transition financing, meaning that we need to support the current brown industries to become green. And if you look at green financing, they are more narrower in scope, but the transition financing is a much wider concept, where we are actively helping and financing companies that are currently using fossil fuel, but are trying to come up with pathways to become less dependent on that, and then eventually or gradually move to net zero for them as well. And that is probably the widest financing flow area for the finance sector today, that this is where I think a lot of the financing actually need to go.
Thank you, Yuki. I see a raised hand by Henry and Dede, and a question from Catherine, RCOPNG. Let's start with Henry.
Thank you, Yuki, for that presentation. Ordinarily, somebody will ask, how is the geographical distribution of the banks that have committed to the responsible banking? But I would like to put it the other way around. How is the geographical distribution in terms of the finance injected into these particular aspects? Because banks could be everywhere, but in terms of regional distribution, where do we see most of this finance going to, especially in the south-south or rather north-south axis? It might just help because there has been this debate that the countries that do not contribute as much to the climate change problems are suffering the most. But are we having finances directed in this direction that can help them do things, do adaptation, mitigation, and all that? Thank you.
Yeah, so traditionally, a lot of our work with the banks have been very much on risk management, meaning that it was, for them, environmental and social issues were about whether it held more risk to them. Like financing for coal today is a big, it's more of a risk for them, both reputational and policy risk, than holding, kind of green investment. So a lot of the banks are very much coming out from that angle, that they understand environmental and social risk from a very internal point of view about whether it makes money for them or not make money for them, and whether it's risky if they are lending in brown businesses that are going to be policy-wise out of favor from the government soon. The PRB, the Principles for Responsible Banking, goes one step further to say it's actually impact that you should be pursuing. To understand what is your positive and negative impact that you are creating to society and to the planet through your financing activities, and to be conscious of them and to start managing them and to set targets against that. And that is a really new area for the banks. The PRB was only launched 2 years ago. And so a lot of the banks are now starting to think, what are the new product developments that I can do that will create those positive impacts? And so in terms of South or developing country context, a lot of the banks are looking more at the social issues. So looking at how they can support SMEs and support the green recovery. So they are looking at similar things to what the UN is looking at, but at the same time, they have to make money out of it as well. So they need to make sure that that is also taken into account. But the idea of financial health and financial inclusion being a target for the banks to develop is something that is quite welcomed by all the retail banks around the world. So I'm not sure if I answered your question, but basically, I think it's quite early days for the banks to be cognizant or to be self-aware of what their impact is of their lending to the local community and to the planet and the environment. But they are starting to think of their business in that direction today, knowing that this could actually be a measure of their competitiveness going forward in the future.
Most appreciated. Thank you. Thank you.
Thank you, Henry and Yuki. We have a question in the chat from Catherine, PNG, assume that's Papua New Guinea. In countries where capital markets are less developed, are there examples of leveraging, partnering with domestic superannuation funds for green finance or blended finance projects? In my experience, I don't know about superannuation funds specifically, but there are funds in countries like Senegal, Nigeria, Ghana, that are similar to or part of sovereign wealth funds, which not only invest for the purpose of creating a pool of savings for the country in the future, but also to address economic development and other needs, including climate. None of these funds, in my experience, are exclusively devoted to green, but they do make investments that definitely fall in the green area. For instance, the fund in Senegal has invested in solar power plants. I do believe personally that this is a very interesting source of commercial capital for the green space, especially in countries that rely on non-green activities such as fossil fuel production for really much of their economy. It would seem like a natural thing to do for these funds to use the capital that has been generated ultimately out of the fossil fuel wealth to address the long-term green needs of the country, and also as a potential way of promoting a transition away from fossil fuels. And I think on the topic of transition, I don't want to really go off topic from the question, but I think on the topic of transition, one interesting aspect is the concept of just transition. So for developing countries that rely on fossil fuel production for much of their economy and also for obviously employment opportunities, it is interesting to see how the transition to green climate finance can create, an additional avenue of economic wealth and employment. Okay, so I hope this answers Catherine's question. We have a raised hand from Karef Rafizura. Karef, please go ahead with your question.
Hi, Gianni. This is Karef. Actually, it's not a question, but I would like to share the PEA initiatives in Myanmar in relation to the topic. Can you please confirm, Gianni, that I'm audible?
You are indeed.
Okay, thank you. So I'm sure you're all following the developments in Myanmar. The political and economic outlook are both negative, not very encouraging. And I'm sure you're wondering why I'm talking about this topic when it's not really an ideal time to be talking about private green finance. But please bear with me. I will share two linked initiatives undertaken under the PEA to advance environmental sustainability objectives and at the same time supporting the recovery of financial institutions and small businesses. So the PEA has a long-standing work on strengthening the capacity of the country to do environmental impact assessment. Before the military takeover in February, Gianni mentioned in the beginning that this was directed towards the regulator. After the coup, we redirected our assistance or capacity development support to private sector and independent project developers. We think based on our stakeholder engagement, we think that there's a very strong argument to continue doing this work. First and foremost, because EIA procedure is relatively new in Myanmar, adopted only in 2015, and hence, there's a relatively very young experience in terms of conducting environmental impact investigations. So we continue to do this work, and we develop a lot of materials, including a capacity development program this year for civil society organizations, technical institutions, and private sector actors to strengthen their capacity to, one, conduct environmental impact assessment, two, put in risk mitigation measures, and three, to also conduct public consultations in a more robust way compared to how they've been doing it in the past. And it's not very intuitive, but this is something that I learned recently. So what does this mean actually in terms of promoting private green finance? So in our engagements with financial institutions, one of the gaps that they pointed out is the lack of reliable environmental impact information in deciding whether or not to lend to projects. So moving forward, what we want to do and what we will do under PEA, starting this year, we started designing a technical assistance program for financial institutions to engage them to incorporate ESG principles in their post-crisis recovery plans. And one of the specific capacities that we want to develop there is how the banks can actually utilize the outputs coming out of the EIA process. So we're really grateful that the PEA board actually allowed us to continue doing this work. A lot of projects have been suspended or discontinued, but we are grateful that we are able to continue this important work here in Myanmar. And we're very interested in learning about global international experiences. In particular, I'm interested in what Yuki was talking about, transition financing. So looking forward to be in touch with all the experts who presented here and to the community in general as we move forward in this work. Thank you very much, Gianni.
Thank you, Kareth. We have a question for Yuki. It's a request of a contact at the Internet Finance Initiative from Assam and Sri Lanka.
Yeah, I'd love to contact Assam. So if I can just have your email address, I'll follow up after this webinar. Thank you.
Okay. I see a raised hand from Sandy. Sandy, feel free to
Thanks.
ask your question. And
Thanks,
perhaps
Gianni.
introduce yourself. Yeah.
Can you hear me? Thanks, Gianni.
Yes.
Thank you. Thank you for the presentation, Gianni, Yuki. And it was also nice to hear an old friend, Henry Ndede, in the forum. Mine is just to probably get some thoughts from you. The Africa Green Finance Coalition is actually a reality that has come out of the COP. And, we've seen that, and we've had, that $130 trillion is actually being mobilized towards climate and green action. But then when you look at Africa, transparency is actually going to be a make or break for Africa in terms of how we attract some of this funding. So I just wanted to get a sense from either yourself, Gianni, or Yuki, how do you see Africa handling, the transparency challenge, especially given that, the Africa Green Finance Coalition is now a reality coming out of the COP. Thank you.
Sandy, can you elaborate a bit on what you mean by the transparency challenge?
So when you look at the dynamics around green finance, and I'll give green bonds as an example, there are normally those requirements for, issuers who come into market looking for green financing and looking to raise green financing. And one of them is the fact that you have to report on, the nature of the project and the use of the proceeds. But then when you look at Africa, attracting funding normally, there's normally, and I say this in quotes, there's normally an issue around transparency where, investors feel that the risks in Africa, when you look at channeling of funds and deployment of funds, transparency is an issue, and it takes the risk perception within Africa to an unsustainable level. But then coming out of the COP, the Africa Green Finance Coalition is actually a reality now. And for me, I'd like to see, Africa really attracting a lot of the finances that were pledged within the COP. But then when you look at transparency, I just wanted to get a sense, how do you see Africa benefiting and attracting a lot of these green finances, especially when you look at opening the market through transparent systems and transparent frameworks for, use of proceeds when you look at the green finance, the green financing that ideally we need to tackle some of the climate issues in Africa. Over.
Sure. I think, from my perspective, two angles. The first one is private finance is, at the end of the day, a market process that's matching demand and supply in a voluntary basis. It's very much capitalism, I guess. Sometimes I think there is a bit too much emphasis on what someone else should do to improve transparency and governance in places like Africa, as opposed to what the issuer of a security should do. If a company wants to issue a green bond, it's first and foremost its responsibility to do the best efforts that it can to meet the standards of transparency and proper governance that are expected from investors in the green bonds. So I think that's something we must keep in the back of our minds. It's not someone else's problem to fix. It's first and foremost a problem that the issuers of securities must address. Having said that, there are regulatory efforts to standardize and facilitate the definition of the use of proceeds for green bonds. For instance, green bonds are now a fairly, I would say, very much a mainstream product. They are not regulated in a mandatory sense, but there are market standards that have been now widely adopted. The green bond principles issued by ICMA, I think, are the underlying principles used by a very big chunk of the green bond industry. They're not super detailed when it comes to defining what the eligible uses of proceeds for green bonds are, but they've been used as the starting point for additional regulatory effort that go more in detail specifically on the use of proceeds. And for instance, the European Union Sustainable and Green Finance Taxonomy is a prime example of that. It's very much a detailed list of eligible sectors for the issuance of green bonds and for the application also of other sustainable financing instruments. So my recommendation, I'm really not in a position to make a recommendation to an entire country or continent, but my observation, I would say, is that developing countries could refer to some of these principles and taxonomies, even if they're not specifically issued for their region, but they've been now adopted by big chunks of the investment industry. And I think using them as a reference and adapting them to the African context could be useful in reducing the risk perception of foreign investors. In addition, as I said at the very beginning, to their own internal efforts to improve transparency and governance, business enabling environment. These are long-term issues, but they need to be very much tackled by the countries themselves and the private sector and the countries themselves.
Can I add to what you said, Gianni?
Go ahead.
Yeah, I think, Sandy, your question is really pertinent and important, because transparency is such a big issue in green financing and sustainable financing in general. And it is one of the most difficult areas for transparency and like traceability, all accountability, governance. These are where I think a lot of the developing country institutions struggle, and also developed country institutions as well. But and one way of doing this is to try and centralize the knowledge through institutions like the local banks that are signed up to the PRB, to be the advisors and supervisors of the end recipients. So rather than each company trying to figure out how to do it to access the fund, that it is centralized through, in chunks by different banks that have more ability to, that they already have some capacity, and maybe they need to add more capacity in this area, but to respond to the demands of the fund, because it's going to be really difficult to do it at the individual level. And the banks will then advise their clients on how to gather data and how to report in the way that is expected. The other thing that I would also suggest is that the KPIs, the key performance indicators that are reported, are kept as simple as possible, and that it's negotiated upfront with the fund or the donor to make sure that it is very specific and measurable, and that it is doable for the country, so the country or the recipient, so that is, the KPIs are thought through well in advance of taking up the financing. Thank you.
Thank you, Yuki. I don't see any other questions, so I would pass the word to Jonathan Gilman, PA Focal Point for Asia Pacific, for some closing remarks.
Yes, thank you very much, Gianni and David and Yuki for steering the conversation today. It was just, I just wanted to touch on a couple of highlights. Firstly, it was great to see some of the outcomes of the COP26 meeting already beginning to leak into our work, and Yuki was referring to the Glasgow Finance Alliance that UNEP is playing a key role in. What she didn't mention is that of the 400 institutions in this financial alliance, their combined money that they manage is more than $100 trillion. So this type of work can really have a significant, by engaging with these banks and financial institutions, we can really significantly steer finance towards the SDGs. And then the last point I wanted to make was I saw that there were a number of us resident coordinator economists, office economists in the meeting today. I think all those Jonathan Gilmans, most of them were in fact economists from resident coordinator's office in the region. It's great to have you participate as well as the other participants, because that we are seeing an increase in demand from resident coordinators for this type of private finance support and guidance in terms of what the UN can do. So I hope today's presentation has helped to put some ideas in your minds about what could be done. And that's really all I wanted to say. So let me, Gianni, say thank you to you again for a great job in shepherding the discussion and informing it. And participants, please do feel free to follow up with us after the meeting. And we will share the PowerPoints. And thank you all very much for coming and participating. Thank you.
Thank you, John. With this, the webinar is finished. Thank you to all the attendees and those who asked questions and made comments.